Hello, thank you all for joining. Really great. Sure, a few more people will be joining as we start, but let's kick off. Chris, thank you for taking the time today to speak to this audience and doing this with Peaks and Capital. During the registration, we had a number of questions as well. Thank you all for filling in these questions. One of the questions was whether you intend to invest in digital assets in the next 6 months. And 2/3 of the people that registered said yes to that. So I think we're speaking to the right audience today, Chris. I will hand it over to Rayan today because he's really the expert on the digital asset space and the host for today's meeting. So Rayan, over to you.
Thank you, Patrick. It's my pleasure to have Chris here. Not only one of our clients, but I consider him a good friend as well. And it's really an opportune time, especially for those of you who've been watching the disaster of FTX and crypto last year, to be re-engaging with the space right now. I think there's lots of activity going on beneath the surface in terms of building developer activity and solutions to some of the issues that caused really the downfall of the space last year. And the markets are certainly reflecting that strength right now in terms of the price of Bitcoin and so on. But I'll hand it over to Chris. He's going to speak about the space in general, and then later on about the specific way him and his firm basically address the risks and the opportunities within the digital asset space. So thank you very much, Chris. I'll hand it to you. Thanks.
Sure, my pleasure, and want to thank everybody for taking the time. This space probably is the most rife with disinformation and misinformation. There's quite a bit of propaganda, both bull and bear. And so we really like taking the time to have this opportunity to clarify any concerns, questions, to represent why we're so passionate about the space, and also bring some professional, asset management to the space, because it's relatively new, yet a lot of people have come and gone based on investor demand and the volatility space. We've basically been doing this now. This is our 6th year, started in 2017. So we're pretty weathered, and we call it Survivor Alpha at this point. But I think to just kick it off with, why crypto? There's a lot of different vectors you can come at this, but primarily our whole group is contrarian value, and we're all bears, right? So what we know to be true is that there are really two things that reflect whether something is valuable or not, and that is scarcity, number one, and fungibility, number two. So now, fast forward, 12, 13 years of Bitcoin being talked about, issued, invested in, you've got an opportunity where to the previous high, you're going to make almost a 3x, and you've seen all over a decade of on-chain development on the space and on-chain data on the space, the movement of L2 on top of Bitcoin, et cetera, that it's hard to argue against the fact that this is the hardest money in the world, one of the scarcest assets, if not the scarcest investable asset, and then is fully fungible. So it already meets all of the traditional and Austrian definitions of money, and then it speaks for itself as far as store of value. On top of that, because in this moment in time, you could see how frothy it got in the previous bull cycle, peaking in the orthodox top being in April, May 2021, you kind of have a runway with, call it the top 30 to 100 assets, to know, okay, if I'm allocating here, what's my expectation? Because on a technical and cycle standpoint, we don't begin a new upcycle till we take out that previous high. So you've got that visibility and transparency in a pretty serious asymmetry where in a 24-month period, this asset class can do returns that take the stock market 15, 20 years to produce. So both from a historical store value standpoint and a symmetrical standpoint, you ought to be paying attention to this asset class. The other side of that is that because they are store value, especially the top assets, and because they essentially are call options without theta, meaning they have so much upside convexity that without any time value decay, that it's hard to ignore from that perspective as well. But here, I think everybody can agree that we've got this global monetary debasement. So in addition, you've got the hedging element. So what asset on earth can you buy that gives you upside convexity with a downside, a systemic hedge. There's really only one other one, right? It's gold. You could argue oil in some instances as well. And then lastly, one of the things that's really intriguing to us as a team, and we really like underwriting all of these assets from a fundamental perspective, is the innovation that's going on in Web3. You've got really the tip of the spear on a lot of disruptive vectors within the Web2 sector. And a lot of these assets can really take the position against sort of the big seven tech stocks, for example, where you're providing decentralized services for almost free. And really that type of competitive landscape on the tech space excites us. And so you get it as an investor, the ability to participate in this potential paradigm shift, because the end result, if this takes hold and adoption kicks in, is not only are early or medium term investors going to do quite well, but we're going to change the paradigm of the economy globally for the better. More creativity, more innovation, and most importantly to us, larger freedom of choice. Like I know, Ryan, you guys run an enterprise. We are limited in what enterprise software, what enterprise accounting, legal, et cetera, we can use because we're given these, legacy solutions or Web2 solutions. Web3 cuts costs down infinitely. For example, in 2022, you had 152.4 trillion B2B transactions at a gross cost of around 6%. So human beings getting charged that much just to transact with one another, it's kind of insane that it's gone on for this long. But when you juxtapose that against Bitcoin, you're looking at a 0.02% cost. So in every way, shape, or form, this is going to better the economic environment by being frictionless and low cost, and then benefit the psychological of both developer and investor by more freedom of choice. So I think, I've said a lot here. If anybody has any questions on that, I'm happy to address that, or we could move on to who we are, what we do, and why we do it.
Yeah, everyone, just to open this up to everyone on the call, we would love you to participate with questions as and when you like. You can raise your hand, you can type, or you can just chime in anytime you like. We'd like this to be an interactive call, so feel free and don't be shy to get involved. Thanks.
Yeah, this is meant to be enjoyable and super transparent. Go ahead and interrupt me. Happy to address any and all concerns. Well, basically, we come from the HFT market making quant space, ran a volatility arbitrage fund for about a decade before going kind of all in on crypto. And we see the opportunity set kind of as having 4 or 5 different sectors / vectors. Like one is just the growth of an emerging asset class. And many investor that is on this call probably remembers the late 90s. I was still in high school, but you had both the boiler room example with the we're raising money for not the company doesn't even have a product, right? So that is a good, auto harmonic to the cycle 2 years ago, where a lot of money was thrown at the space with good intentions, and that brought out the hucksters like the FTXs and the BlockFis and the Celsiuses, et cetera. And it's not any different than any other hype cycle, regardless of the asset class. So in my eyes, we went through a really destructive but very capitalistic bear market that kind of sussed out a lot of the bad actors, and then sussed out a lot of the assets that don't offer true value propositions. So in my eyes, it was a great thing to go through. Painful, obviously, but throw in the regulatory side and you've got kind of that max bear situation that then turns all contrarians bullish. You just have to have a little patience. So what we run is a multi-strat hedge fund. It's called Libertas. I will quickly run through some slides here just to kind of show you a piece of our deck and have it for talking points or questions later. But essentially, we have been able to outperform the space kind of via the magic of compounding and by really only having one rough year, which was last year. And how we are achieving that has rotated over time because of the maturity or immaturity of the space, kind of both. And our approach is one that's taking a traditional multi-strat discipline where we're combining non-correlated systematic and quantitative strategies with a long book with a options and futures overlay for hedging. we are all Austrians, as I said earlier. So this quote means a lot. It's actually on our shirts. It's on our website. So any of you who are very well read, I hope this speaks to you directly. And this is where I kind of hearken to the forefathers of America, that if we want free enterprise and a market economy to survive, we have no choice but to replace the governmental currency monopoly. I think we all can agree on that, and that we are all victims of this system, whether we're conscious of it or not. So this is kind of going over what I just mentioned on the opportunity set. I'm happy to dive into each of these segments deeper, but like I said before, we definitely have a roadmap to comparative adoption of new technologies. So we're not just stabbing in the dark here. And this chart here kind of shows where we are if we're comparing it to the internet. And again, we're a diversified quant-driven digital asset manager. Unfortunately, we're older than I want to admit. Our eldest is 51, I'm 42. So we do have a deep pedigree in the traditional space, roughly 7 years in crypto. We all were personal investors going back to 2013, 2015, Ether pre-sale, et cetera. So we personally have invested in the space pretty much within 2 years of it launching. We built this hedge fund, to be very frank, so that we could pool our personal capital more efficiently and trade across the various global jurisdictions. And I'll get to explaining that in a moment. The fund itself is designed to be high alpha risk managed way to asset the space. The fund uses no leverage. We use our own software. In fact, we built the first OMS EMS system for crypto, which was called OmniX. We sold that to Gemini in January of last year. So we have a heavy developer background and build all of our own algorithmic execution algos, as well as the strategies themselves. This is essentially the matrix of quantitative strategies that we have. Low latency trading has been difficult year to date because of low volume and lack of liquidity. And lack of volatility, to be very frank. But what our approach really is focusing on being all weather. We definitely have a long bias. We never go net short, and the blend is so that we have more arrows in the quiver winning than losing, and that happens to be the case even today, where about 80% of the strats are winning and 20% are losing. So we want to live in that middle if we're looking at the maturation cycle of the space. The team itself, like, to get into who we are, let me go to that here, because it helps put it in context. Oops, sorry. Forgive me. There we are. My background is from Morgan Stanley. Have taken, unfortunately, every serious exam that matters to an iBanker or trader or hedge fund manager, CMT, MTSA, blah, blah, blah. So my role, in addition to being co-founder and PM, is primarily volatility trading. I trade the options and futures book and then design about 60% of the algos that we have in play here. Our other strategy director, Chaim Bodek, who also is co-PM with me, he basically invented high-frequency trading while at Blair Hull in '97, had 10% of U.S. listed options running through his tech for over a decade, while at both UBS and Goldman Sachs. Kamel Mokadem's our head of quant research. He also ran Toby Crable's book for 11 years, also built CurrentX, which sold to State Street. That's an FX platform. Kamel does quant development on the algo side as well as software development. Our COO, Matt Rosen's been with us, been with me since 2010 on our previous fund. He's a trader and one of the best COOs that I've ever come across. And then we have a JD MBA chief regulatory officer who also has taught securities classes. UCLA has worked with the SEC his entire career and sits and liaises between our offshore counsel, onshore counsel, and essentially our fund takes the position that we're complying with both existing commodity rules and SEC rules. So it's both CFTC and SEC, because we want to make sure that in the event of any further crackdowns, we are already compliant with both sets of regs. And then the European regulation, we have also gone over and are compliant with that as well. And then Jeffrey Ties, our DeFi PM, as well as one of our devs. He was one of the platform architects of Omnix, so we've actually worked with him since 2017. And then Rishi Narang happens to be another super famous quant. You may have read his book, Inside the Black Box. He's our advisor and also equity partner in the space. He oversees the macro strategies of the fund and then backtests and tries to break all the quantitative strategies. So let me get back to the portfolio real quick, now that you can understand who we are. The strategy matrix is not too far off of the concept of 60-40. Why do we take this approach? Really, there's no point in being in this space to try and make 10 or 15% a year. We want that asymmetric upside, and we believe these assets are extremely undervalued and probably will be for a few more years. Even at the peak in 2021, they were still undervalued. So we think this combination gives us enough alpha from the lower delta market neutral style trading of the quant systematic side with the upside potential of the fundamental long book. We currently hold between 25 and 30 names. We actually benchmark to the CCI 30, and we trade those same 25 to 30. We think that that's a not only scalable amount, but we can be diversified enough in the 5 sectors in crypto with those, and we don't want to run just a bit in ETH portfolio. The combined allocation to both is about 47%. So we do hold, decent sized positions in a lot of cryptocurrency assets. And essentially, that's really it for me from running through the pages on the deck. I'm happy to go through specific questions, and really, I think the last point I would make is how we do it is much different than traditional funds. I can actually give you a slide here that helps with visualizing this. So unlike at least our experiences as U.S. hedge fund managers, you typically would have 2 or 3 prime brokers. We had GSEC, JP, Cantor Fitzgerald, and then EDF and Man back when we were running the Vol Arb Fund. Here we've done more than 120 DMA connections since 2017. And now, since about 90% of volume goes through 8 exchanges, we've been able to kind of sub in and sub out as needed and have 15 trading counterparties that we've used pretty consistently for 3 years. All of the purpose of that is not only diversification, but to get best execution, arbitrage where available, and because all of these venues have differing listings of assets, different types of technology, and we want to make sure that we're not going to be relying on one venue to trade. To that effect, we have 4 custodians because our long book is largely either in cold storage offline or in nodes to enhance our yield. On the staking end, that's where the nodes are run on our behalf. We use 3 institutional providers, and we keep at any given time 3 or 4 banks to ensure that we can maintain operations. I happen to be on the board of one of the banks as well, so we have a little bit of a security as far as being able to have on and off ramps. And then we use 7 different tech and research providers that feed into our software. So our software essentially is aggregating not just price, volume, time data, but also all of the on-chain data. We did build a couple indicators that are in-house that are utilized as factors in our strategies.
Chris, I'm gonna chime in and try and kind of delve a bit deeper into this topic that you're just covering. I mean, yes, basically, it's worth noting. It's pretty obvious, but it's worth looking at this theme that we've seen over the last 6 months or so, that all the participants in the space, asset managers, trading firms, custodians, exchanges, they're all basically, all of you guys are really suffering from a lack of fresh capital entering into this space right now. And that's primarily due to investors' concerns about keeping their assets on exchanges and kind of the absence of institutional grade regulated trading infrastructure, right? And so you've seen, sorry.
Yeah, sorry to interrupt, but yes and no, because one of the points I'd make about why this is a paramount to at least deploy 2 to 5% of someone's portfolio is, while on the surface it looks like you should be concerned with that, it really, when it boils down to it, you don't need to be. Every transaction of in-kind assets. Now, I'm not a big advocate for silly derivatives, right? Like we trade in-kind options. So you can see everything on chain, all the wallets, all the block confirmations. This is super transparent. Unlike let's take a meme stock like AMC. Every time the damn thing's rallied, they've issued more shares, blah, blah, blah. And that's not different from Apple always buying back 10 billion, basically keeping a floor under the stock, right? Both of which are bad. One, you're buying back the company self-liquidating because you have nothing else better to do with the money, which is silly. And the other, you're pigging out on liquidity by pushing down the stock price to issue more to bring in more capital. So in crypto, you don't have that, right? You don't have to wait a quarter to get visibility on earnings. You don't get lied to about so-called ESG policies or so-called social blah, blah, blah policies. This is like commoditized technology wrapped in various either proof of stake, proof of work, et cetera, blockchains. So
well,
I think
this is I think you make a very, very good case and good point regarding the the amazing properties of decentralized technology, right? Where you can see what's going on transparently on the blockchain and so on. But what I was trying to address a little bit more was the concerns from some of our audience today, who are more institutional, traditional grade allocators and investors,
right,
who basically are more concerned about how let's say how they are the type of custody solutions and institutional grade platforms that they're used to being on. And what the question I was really trying to lead up to is, do you see solutions in terms of ways to settle off exchange? That's really to try and really get down to the point, like, how do you trade? You can't do all your trading on a decentralized exchange.
Not yet, but it's actually a great question. So we take the approach that in an ideal world, you have a third on exchange hot, a third in primes that can settle off exchange, and essentially, we're trading with Cumberland or Virtu or Citadel, blah blah blah, Tower, and then a third decentralized. Currently, we only have about 300 bips decentralized because of how difficult it is to utilize, as well as the lower volume. But in a perfect world, it would be a third kind of thing, and then hold cash futures and options with the remainder. So I very much respect and appreciate the concern and the fear. We are operating always from a position of distrust and over vetting. We know what's wrong with the traditional space, right? I don't need to belabor the various points of that. In this space, less is wrong, but the opacity of underwriting has not really been put to a process that people can really understand, on top of the fact that the UI UX is difficult for those not in the space and not willing to take the time to underwrite it. How we do it is simple enough to be repeatable. We first underwrite the legal, and this is what specifically kept us out of FTX and BlockFi, for example. You want to know how many entities in how many jurisdictions. You want to read with a fine-tooth comb every agreement, every contract, transaction, settlement, every element of that. And then luckily we do have a fairly decent tech acumen, so we can underwrite tech. And what does that do? That shows us that there's wash trading, there are cross portfolio margining at the exchange level, there's omnibus mixing of client assets with firm assets, and that's actually super transparent if you know how to underwrite it.
Yeah, so I think Chris, you've done a fantastic job, at basically, really doing rigorous due diligence on your counterparties, right? Like that's been evidenced. You completely sidelined FTX and other blow-ups in the space, because you were able to really forensically be able to see through some of these platforms' issues and basically avoid them. But in a more wider angle, coming also again from the traditional allocator's point of view, they're looking for a solution where they know their assets are going to be, there's two sides of it. They want their assets to be kept off exchange, right? That's clear. And then you want to be able to operate efficiently without having to have fragmentation of your custodians, because today there's not one custodian which you can go to which will have all the exchanges within their walled garden solution. That doesn't exist.
Well,
today.
and then no, it doesn't. And then the walled garden, you're taking creditor risk with that one counterparty. I'm not saying we're fans of it or not fans of it, and I'm not saying that some of that tech can be good, but you're actually introducing another layer of risk by trading on the credit of a custodian. So, the way we kind of solve for that, not just with the diversification, is making sure we have on-chain settlement, so that it can be referenced in every single thing that we do, whether it's trading with a prime or it's trading on a SEX exchange or a DEX, for example. We do. I mean, if I could run a forever fund that rebalances quarterly and it's 100% long or 95% long and it's off exchange cold and armed guard storage, I would love to do that, because that actually is one of the benefits of these assets. Are you can own them, and for very low cost relative to gold, silver, of which I personally own and advocate for as well. You get that same sort of security. And I like taking advantage. That's why we have that net long book, is we're taking advantage of one of the best attributes of the space, which is that cold storage off exchange. Can
you maybe comment on two things? One is currently how in terms of cybersecurity and asset custody, how Hyperion Decimus Libertas safeguard your investors' capital right now, and then two, basically, how do you think perhaps solutions may enter the space which are more analog, or like Web 2 solutions that may come in to bridge the gap between traditional investors wanting that traditional institutional grade custody and what's available today? Maybe you can comment on this.
Yeah, of course. And realistically, since I do have that experience with the traditional, we have institutions in this fund and had institutions in our previous fund. The reality, in my opinion, is that I felt less safe at GSEC than I do at Coinbase. Why is that? Essentially, especially with HFT trading, we're essentially inside of a box that's like settlement arbitrage is really what it is, right? And you're trusting, without any asset actually coming into your account held separately in your name that you can identify, you're just trusting the counterparty to produce the right numbers. And there's not been 1 year of mine and my partners' traditional experience that there's not been issues, whether with GSEC, Cantor, et cetera. So in this space, while it is complex and there's a lot of segments to underwrite and learn about, you don't have to question the settlement. And so trade reconciliation, while a pain in the neck for people who trade up to maybe 1,000 trades a day, it's difficult, but we built software to process it. You can reference every single execution by tick, by venue, and by asset. So I jive with the fact that they want it to look and feel like previous primes, et cetera, but it's never going to do that because it's different. And that's a feature, not a bug. So I think depending on someone's willingness to dive into this, it becomes more and more transparent as you begin to move these assets around, and you're confirming. But to your point about cybersecurity, that I think we've, again, not to pat ourselves on the back too much, we kind of were leaders coming out the gate in 2017. We actually had a publicly traded firm that everybody knows, cybersecurity, built us front end hardware and actually our own token for signatures, for shared security, and for MPC essentially. We have quarterlies with these guys. Like I can't mention the name because they haven't actually rolled this out as an enterprise solution yet. But nonetheless, in addition to that being the security of how neither counterparty nor partner can move money without the multi-sig. Every 30 days, the passwords, we've got over 125 of them, recycle their 20 something digits all this crazy stuff, and they auto recycle for each person. So there's not some like macro login. And then in addition, we run my chief technology officer, because we do have some staff that are not on the deck, runs his day-to-day to fully analyze all of our nodes, servers, et cetera. Because how robust we have on the server side, all of the algos run on Linux, and then we back up, have redundancy to DigitalOcean, and then that has redundancy to AWS. So there's no single point of failure, at least, even if a hurricane comes and hits Florida, of which we've had like 7 or 8 since we've been in business, there's no way that we're going to go down.
Amazing. So okay, Chris, I have a question actually from Adrian. He's asking if you could please speak about the implications that the FTX blow-up had on the fund, e.g. the availability of market depth, retail deleveraging, and the availability of market depth in terms of liquidity. That's from Adrian.
Yeah, we didn't have assets on there, so we didn't have assets stolen from us. But obviously, we suffered in the running and hiding and turning off, and because at that point, basically from May to November, it was so chaotic, and our goal was to make sure that we protected the principal, which, you can look at the down high 40s in dollar terms, but then I look at it in crypto terms, where we actually had 32% more crypto at the end of the year in 2022 than we started with. So yes, the order book depth has dropped almost 2 standard deviations. That's again bullish and bearish. The bullish side is on things like Bitcoin and Ethereum. You have either a lot of the transaction value locked staking Ethereum, which is awesome, because roughly 100% of Ethereum has been issued. The only thing that's not is the yield produced on the staking. So you've got full transparency into that as well. Bitcoin, roughly 73.5% of Bitcoin is off exchange and cold. The historical is about 19 months of that being held. So there's a plus and a minus. The minus is we don't have the spread and the order book depth to do a lot of order book alpha or HFT style strategies. And then on the other side of it, it's lowered volatility, where it's about 12-13% higher than stocks. So I like high vol and maximum organic price discovery, but here you have to appraise every factor for what it is. And it's bearish for some aspects of trading and bullish for some aspects. And if I didn't answer that, please continue and I'll drill down further.
I'll just open it up in case anyone else has any questions. You can type them on the Q&A, or happy to hear your voices as well. If you'd like to join the conversation, that's fine.
I'm gonna X out of the presentation here so I can see the questions. Let's see.
If no one has a current question, feel free to interrupt me, but I'll ask another one myself. Just in terms of, we touched on this already. In terms of regulation, in the space evolving pretty rapidly, how do you guys navigate the landscape, particularly, obviously, that you're in the US? How do you go about doing that these days?
Expensively. So, very ironically, I took Gary's class at MIT, his first blockchain class years ago.
Yeah, he's talking about Gary Gensler, head of the SEC, by the way, guys.
and you know what? I don't get duped that much, but he definitely duped me. And then Silvio, the founder of Algorand, was like the primary blockchain professor. And essentially what I did is I wanted to learn how to code blockchain before launching a fund, and then fell in love with it even further. And I'm like at least competent on proof of work. Because back then that's really all that existed. So we thought, oh, he's pro crypto. Look, he taught the MIT course, 3-4 years in a row, and we're going to get an advocate in there. And boy, did we learn the hard way that that wasn't the case. And then unfortunately for what appeared to be his good friend Silvio, basically put him out of business by calling them security, and single-handedly ruined that blockchain and the development on it. So it's very sad as a human being to bear witness to that, when there's no wrongdoing, there's no for-cause justification. It's just the global oligarchies don't want competition, and I think everybody agrees with that. So for me, I was a little bit brokenhearted because I thought we were going to get transparency. I thought we'd get, okay, some of these assets are securities, right? Especially if there's cash flows that flow up to a parent, then they absolutely are. But if they're full commodity, then that's CFTC. So we, like I touched on earlier, we are over compliant. Whether it's the recent Euro regulations, we make sure that our lawyers, not me, we have 4 different law firms, by the way, make sure we're compliant to the best of our ability with each regulation set. What I will say is that the friction there is an opportunity, not a problem, right? This will get resolved, good or bad, right? And if it's resolved bad, then you react to that. And if it's resolved good, then if you're not already in, then you're going to miss quite a bit. So I see that there's a question here. What is your current...
Peter, what is your current strategy allocation and where do you see the best opportunities? That's directed to the 30% weighting in your discretionary portfolio, I'm guessing,
Yeah, great question. The macro allocations that you saw are always remain the same. The underlying strategies do change, whether through rebalancing or through seeking more alpha. On the long side, we really see opportunities near term in L2s, and there's a lot of L2 activity, primarily on top of Ethereum. And there are certain assets like Optimism and Arbitrum and Coinbase's Base that are doing quite a bit of volume and getting quite a bit of fees for providing that L2 solution on top of Ethereum right now. There's about 10. Matic is, I think, ranked 9th. And we deploy capital essentially in proof of work, L1, L2, DeFi, and then a little bit of sort of Web3, like pure Web3 or metaverse, as you'd call it. And I think here you kind of look at it how you would do a stock portfolio here. You kind of look at barbell. You buy the ones that have proven use cases, proven transaction value locked, have years now of paying the yield on the nodes, which is certainly one of the best opportunities where we're getting 7, 8, 9% compounded in kind by running nodes. Like, so if we're just long, we're at least making that. So that's really how we're currently deployed on the long side. And like I said, we do take larger positions in alts. We're not just a beneath fund. So we do have meaningful vol that's enhanced by having a Matic, which is like 52 cents, for example.
What percentage of the overall fund, let's say of everything, maybe give us a range at any one time, is Bitcoin of the overall fund?
It is a range depending on liquidity, right? So the top end is of just Bitcoin, including long plus trading, will still be sub 50% if it's fully allocated, right? Between Bit and ETH, currently it's 47.
47 of the discretionary part of the portfolio?
No,
the whole because you're trading in the systematic strategies, you're using those pairs as well, right?
Correct, yeah.
And
so we look.
Okay, go ahead. Yeah, no, go ahead, please.
Well, the way our software queues it in, it's by strat, by token, and then fills up in a total portfolio picture that updates every 15 minutes. So we're seeing it kind of from a macro, and we're fairly agnostic because we have mean reversion, momentum, market neutral, traditional long short that are all different types of factors. So at any given time, if it's a mean reverting environment, which it really hasn't been year to date, that'll be firing off all the time. It's also not been a momentum environment, so a lot of those there'll be 1 or 2 names trading here and there, and at least it balances the overall capital at risk at any given time.
Okay, we have another question from Adrian. Thank you, Adrian. From an operational standpoint, what changes have been implemented since the turmoil year of 2022? Which lessons have been learned? Could you also speak on whether you use stable coins, and if so, for what reasons, e.g., ease of exchange transfer or other practical reasons?
Great question. Lot to unpack. We didn't learn anything and we didn't change anything because we went in already being contrarian bears, so we already figured something like this was going to happen. Just because you'd seen it in whether it's like the commodity ETNs, which was post '08, the IPO, tech IPOs 97 to 2000. Like this is a pattern that human beings continually create. And so we had already put in place rigorous underwriting. I think maybe to speak to how it's changed, I think we've processized that a little bit more to where, all right, if they don't have multiple banks, if they don't disclose all of their legal jurisdiction, if we don't have an ISDA between a prime, like all of that to make sure that we're following the protocols as if we were trading with GSEC, for example. And then really a lot of it comes from underwriting the tech, and then lastly, underwriting human, right? It was very clear for many reasons why you shouldn't touch some of these counterparties. And a lot of it is like, if they're doing a lot of marketing, they probably don't have anything legitimate. I mean, it's true of all sectors. So, we stayed away from no rehypothecation. We have these rules hard set. So no rehypothecation, everything settle in kind, whether options, futures, etc. So that just keeps it so that we can manage it. And I think what we learned is that it was to a larger extent than we had expected. And then as a result of kind of shooting from the hip with best practices, we've now put that to a specific process.
You also were, correct me if I'm wrong, Chris, but you did have some change where you were able to integrate some more shorting capability in your systematic strategies. Is that correct? And that
Yep.
and had the structure of the market provided you with the possibility to do that earlier, maybe that wasn't available to you. I don't know. Maybe you can tell me, but that would have dampened your drawdown, last year. I think, right?
It would have, and everything's material, but we also are patient and do things process driven and with the utmost discipline. So we would not trade, speaking about the regulatory, we would not trade perpetuals because the CFTC said they were illegal. Now, I don't like silly, derivatives, because I don't believe this space should be subject to over financialization, and the thought of a perpetual is just insane. Like a calendar future is fine, but nothing is perpetual. So we are already adhering to that, and therefore we could only trade CME and then long flat. As of May of 2022, we helped build the tech with a lot of these counterparties, like an SBox, a Blockfills, and Falcon S, where it took a ton to get to lower latency trading. We're talking like 1 minute, not like mils, and then fully rolled that out in May. Of course, a lot of them unfortunately went down or stopped trading, whether it's Amber or they had 3 arrows exposure. So right as we were ready to launch another higher alpha segment of the fund, it was limited to only a few hundred basis points until about really December. So that's now half of the quant book is trading in a long short spot manner.
Okay, a couple more questions from Adrian. The first one is kind of getting a little bit away from the trading side. What conviction do you currently have on the tech side within the space?
That's probably the easiest for us to have high, very objective and subjective, admittedly subjective opinions about the space. I'm critical of a few things. If hopefully this answers you, I'm critical of consensus mechanism. I'm critical of finality. We want fast finality. I'm critical of demonstratable use cases. And then we're critical of the strength of the infrastructure itself, whether it be the smart contracts individually or a specific DeFi protocol that may be subject to hack or wormhole, et cetera. So we were able to really hone in on that aspect of it. And again, how you can underwrite this, I don't know if anybody's a developer on here, but you can go to GitHub, see real time. We actually talk to developers for every token. We have access to every founder of every token we invest in. We've advised DAOs and foundations that are part of these token groups. So we're hyper active. And then I happen to have no filter. So if there's something somebody's doing I don't like, I tell them. And then Jeffrey Tai is like the Jedi of DeFi. We write internal research on DeFi scoring and rating structure. Some of it has been poached and published without our permission, but anywho, and we started doing that years ago, like really 2020 before anybody even jumped on the DeFi bandwagon. So
Okay.
that's our approach. Sorry if that was long-winded.
No, it's perfect. Thank you, Chris. And then the follow-up question was, is there any incentive or motivation to perhaps launch a long-only systematic fund? And if so, what would be the catalyst for the launch?
So we're kind of running that as part of this fund, right? Where of the 60, it's 50-50 between long only and then long short.
So you have you have like 8 long only systematic strategies that are uncorrelated right now?
And then 4 long short.
Got it.
Yeah. So there's 12 algos running in that quant book. We have probably 30 that we can flip on, but as I mentioned, the lower latency stuff is currently off for a plethora of reasons. I think, what we're trying to do is set at least a precedent for, here's a fund with 5-year plus audited. We are all weather. We kind of have no cap on what we could run. Call it maybe a $1.5 billion would be probably the closing number. And so that we can use this fund as the prime example of what to do, how to evolve properly and responsibly, how to be super transparent. We're very high touch with our clientele and deliver a success for the space instead of what we've all seen as these funds come and go, whether it's VC or liquid funds. I do think that long only systematic is actually easy to launch. Where we are currently getting solicited by investors to build on the institutional side is sort of a smart beta, like well-timed rebalancing of a basket of 30 to 50 long positions. So we're definitely not a no on that. It's just got to be worth our time. And we may have something to launch, call it beginning of next year, based on those dialogues. The hardest part of it is we do not have enough data on what is currently in the top 100 to trade in very sophisticated quantitative strategies. You can't really go beyond linear regression or point in time models at this time. So we are doing a ton of machine learning testing on, let's say, about 15 of those names that have the longest price history. So I think in order to hang our hats on one specific style of strategy, we're just going to need to see a sustainable Sharp be present, which is not the case. Like assets have come and gone, and then one of our favorite tokens like Avalanche is down around $10 from 247, I believe, and there's no volume, no liquidity, et cetera. So how would, if we have that as 10% of that allocation, it's just not something we want to hang our hats on solely at this point. But we have been asked to build it and test, which we're currently doing.
Great, thank you, Chris. I mean, I can't see any more questions. One simple question I'd love to ask you at this point.
Well, and just to harp on the machine learning,
yeah.
we have 4 A100 and H100s from NVIDIA in our data center in Hawaii. It's actually on Kauai. So we're running, similar level sophisticated analysis like we would on traditional HFT stock futures, et cetera.
Great stock to own as well these days.
I'm out now. It's too expensive for me. But I was in the IPO, and I do love that company. That's best tech on earth, best hardware on earth.
So just to round things off with a really simple question, maybe let's say relatively simple. Let's talk Bitcoin. Bitcoin is really the name that everyone is familiar with in the space, and is the granddaddy or grandmother of the space, let's say. What's your view on Bitcoin? What's your view on the recent institutional attention that Bitcoin has been getting from around the world? And how do you think that's going to affect the overall space, in the next, 6 months, let's say? It seems like a lot of capital could be getting ready to come into the space.
Certainly that could be the case, and you both know me well. I don't like predictions because they just make people look silly. So as an objective quant and as a subjective analyst, right, I would say normally we would go under the guise of known unknowns are priced in, and certainly known knowns are priced in. In this instance, there definitely is kind of an upside kicker to the going live of the ETFs or ETNs, et cetera, because you know, sans Europe, Asia, America, South America, a lot of the rails have been cut off. So it's not easy to, or as easy to deploy capital in the space like it was previously. But on the other side of that, so I think Bloomberg was quoting like 150 billion, the 10 ETFs go live, they expect that within 6 months. If that occurs, you don't even want to hear my price prediction on BTC, which is based obviously on trend lines, Fibonacci extensions, L8 wave, blah, blah, blah. But I'm, again, my brain and my team's brains have been tuned out of fiat and tuned into crypto. We have strategies that run BTC and ETH denominated, this fund not only is prepared to trade where fiat is not the denominator, but you can allocate in Bitcoin, Ethereum, and you can take out in Bitcoin, Ethereum. There was a question about stablecoins. We do take USDC. At this time, we have used it as bridges between exchanges, especially the offshore exchanges. However, if people listening on this call are getting what I'm saying, you probably already assume that I do not like them. Ironically, the Fed likes them because it perpetuates this euro dollar based liquidity that they can't control, but it sustains a floor against the dollar. And also look at the holdings of Tether. They're a treasury buyer now where there aren't treasury buyers. So, you know, you got to just weigh the pros and cons. I personally don't like them, but I put the personality aside and we use them when it's efficient to use them.
And USDC is the main one you use, or do you have a view on any other ones?
Why we use that is KPMG and NAV Consulting have underwritten and approved that as as a allocation and redemption. So we're just going to stay in line with that. We do know the Circle folks for years, but personally, I like Tether.
Oh, really?
I like the asset backedness of it.
Okay.
I like the transparency of the team. Now we know them. It's just a different ballgame, but over time, you know, we're going to continue to probably overweight using Bit and ETH as the denominator. Bitcoin moves across the landscape really fast because of Lightning Network now. So, and in our opinion, Bitcoin is the true stable coin. I don't mean stable in price, but in stable in tech. I mean, it tries to get hacked all day, every day. It's the strongest blockchain on earth. And we really are fortunate as humans to bear witness to this because it is, for any of you currency or macro economists, this is the hardest money that mankind's ever seen. And I'm not predicting it to be a currency. I'm just appraising it, you know, with the 4 to 7 factors, depending on if you're Milton Friedman or you're Hayek, that makes something a currency.
Do you like the term digital gold?
I
Bitcoin?
do.
Yeah.
I do. I mean, people get really polarized by that, but if you just look like the S&P or Dow in price producer index, the S&P or Dow in gold have not exceeded their 99 highs. So humans have been conditioned to like look at things in this small prism of percent and anchor to the NAV of what they think they have versus taking a look back, compartmentalizing the portfolio. Like this is my commodity strategy and strategies. This is my cash equivalents and fixed income strategy or strategies. This is my alternatives, whether it's hedge funds, REITs, you know, private deals, VC, and then this is my core equity, right? And then manage those all with a sort of interdisciplinary view, so that the main thing that's accomplished, like, you know what makes everybody wealthy? You have to accumulate assets. That's the only way to wealth. So our strategy in this fund is to make sure that even in a drawdown, we have more assets than we started with on a year-to-date basis. And I just know as a long-term investor, the backdrop of that gives us both an anchor to not mess up by trying to chase silly things, but also over time, we get that outperformance through compounding.
Chris, we're coming towards the end of the hour. I just want to say I'll hand it back to you for closing comments. Thank you so much for your time.
What's
today.
my view on Binance? Sorry, I saw that.
Oh, someone asked? I didn't see that. Okay, go ahead.
Yeah, so I'm all about karma, so I hesitate to say anything too good or bad in this instance, but I will tell you that we do not trade on Binance US or Binance at present.
Okay.
That should answer the question.
And there was another question here. I didn't see it until now. I missed it. Sorry, Adrian. It was in the comments section. You touched on the topic of consensus mechanism or census mechanism. Please share your view on Byzantine fault tolerance versus longest chain rule.
Versus what?
Versus longest chain rule. Like the longest chain is the most stable kind of thing. Yeah.
Yeah.
Or the strongest.
I would argue, I mean, I kind of like attributes of both, but I full disclosure am not a good enough blockchain developer to have a strong feeling either way. That's a great question and shows that you've obviously dove into this space. Sometimes I bias one, sometimes I bias the other. Again, I'd like to see more data than just reading theoreticals, but I'm curious what you would pick.
Adrian, you can let us know whenever you're ready. Or
because my team like splits on that. You know, because a lot of this stuff, it's like, how do you solve last mile issues? But again, we're getting way up there. I'm happy to schedule a call separately and dive into that.
Yeah, sure, we can do that. Thanks, Chris, so much for your time. It was a great call. Hope everyone enjoyed it. If there's any last minute questions, you can chime in for one more. Otherwise, just hand it back to you, Chris. You know, thanks very much. And anyone who wants to get in touch with us for more info, obviously you know where to find us. And thanks for being part of this. Thank you.
Appreciate it, everybody. Thank you.